Hello everyone, welcome to FinTalks. This is Dr. Hari Curry, PhD in Finance, having 22 years of experience in teaching and also industry. I worked in Deloitte, one of the big four accounting and auditing firms. Due to my passion towards teaching, I left Deloitte and continuing in teaching field as a faculty of accounting and finance. In this video, I am going to explain in detail about one of the important concept from the financial management, that is capital budgeting. So in this video, I am going to explain in detail various capital budgeting methods, techniques or tools used to evaluate the capital budgeting proposals in detail with the help of the practical questions. By solving practical problems, I will explain each and every method. Before starting about the capital budgeting methods, first of all, what is capital budgeting? So in simple, capital budgeting is a long-term investment decision. It is a decision related to investment in fixed assets, long-term assets. The available funds are limited. So how to invest this available limited funds efficiently in the projects in the fixed assets, that is known as capital budgeting decision. It involves capital expenditure. It is a capital expenditure budget. So in simple, capital budgeting is about investing the current available funds efficiently in fixed assets or long-term assets. And capital budgeting decision is very important because it involves huge funds, large amount of funds are involved, and the decision taken will have a long-term impact on the company's operations, and also the decision taken once cannot go back, it is irreversible, and the decision is about the future which is uncertain. Very important decision. And this decision involves what is various capital budgeting decisions involves means investment in a new project or replacement of the existing asset with the new asset, or expansion of the assets, expansion of the plant, expansion of the projects, or diversification, entering into the new line of projects, new line of assets, or other miscellaneous things like a installation of the pollution control equipment, security equipments, etc. So how to evaluate this capital budgeting proposals? That means how you will know the which asset is suitable for investment, which is best one, that is called evaluation. So the capital budgeting proposals will be evaluated, can be evaluated with the help of the techniques, tools available. The capital budgeting methods, techniques or tools will be classified into mainly two categories. Traditional, that is non-discounted cash flow methods. The second category is modern, that is discounted or time adjusted methods. So the capital budgeting methods are classified into two categories. The category one is traditional methods, which is also known as non-discounted cash flow method. Category 2 is modern methods, which is also known as discounted cash flow method or time adjusted methods. So what is the main basic difference between these two categories, these two methods, traditional and modern, is application of time value of money. Application of time value of money. What is time value of money? In simple, the time value of money concept says that present value of money is always more than the future value of money. Present value of currency, any currency, you can take dollar or US dollar or UK pound or Indian rupee, anything. The present value of rupee is more valuable than the future value of rupee because future is uncertain. We don't know what will happen, may or may not occur. So this application of concept of time value of money is there in discounting cash flow methods. Modern methods, the concept is applied. In traditional methods, this concept of time value of money is not applied. So in traditional method is without application of the time value of money. In modern methods, we are applying the time value of money. How you are applying time value of money? You are converting the future cash flows into present cash flows. So in modern methods, we are applying time value of money. That means the future cash flows will be converted into present cash flows. How they will be converted? By applying the table values, present value tables. How we will do that all we will see in the next coming classes. So in this video I am going to focus now on traditional methods, non-discounted cash flow methods. After completing this next video I will focus on the modern or discounted cash flow methods. So let us start with the traditional methods. Before that, whether it is a traditional method or discounted cash flow method, any method, if you want to solve the decision, if you want to solve a problem, if you want to practical question, if you want to solve, what is the information required? The data required is first of all cash outflow. Cash outflow means the cost of the project, cost of the asset, or cost of the investment, or we can say initial outlay or initial investment. From question to question, problem to problem, language will change, but meaning is same. The basic information we required is cost of the project, how much you are going to invest in the project. That is cost of the project. It is also known as cost of the asset, cash outflow, cost of the investment, or initial outlay or initial investment. And the second information required is cash inflow. That means what is the returns, profits generated from the investment. By investing in that asset, what are the returns generated? That is called as cash inflow, or called as cash flow, or cash flow after tax, or even profit after tax before depreciation, or profit before depreciation after taxes. Different types of, in different ways, different type of language they will use in the question, practical problems, but all are having the similar meaning only. In simple, they are cash flows. Cash inflow, cash flow, cash flow after tax, profit after tax before depreciation. The tax is already minus, reduced, and depreciation is added back, because depreciation is a non-cash expenditure, but you are getting tax benefit on that one. That's why first you minus, you calculate tax, after tax calculation again we will add back. It is also known as profit before depreciation after taxes. And next, life of the project, and then scrap value. This value may be available or may not be available depending upon the question. If it is available, we will consider it as a cash inflow at the end of the life of the project. Scrap value, salvage value, or it is also known as residual value. Also known as residual value. That means it is the value received by sale of the asset at the end of the life of the project. At the end of the life of the project, how much you will receive by sale of this asset, that is called scrap value. And also sometimes they may give additional working capital value. So in between they introduce some more working capital for the purpose of the operations project. If that is available, that is also considered for the calculation purpose. The maximum, this is the maximum information available while evaluating the capital budgeting projects. And now one more important point is regarding cash flows. For all the methods except ARR method, accounting rate of return method, we will use cash flows, means cash flow after taxes. But in case of ARR, accounting rate of return method, cash flows means we will use profit after taxes. So in accounting rate of return method, cash flows means profit after taxes only. It is not cash flows. This formula is based on profit after taxes. So when you are solving the problem practically, you have to see what information is given. whether it is the required information or not required. If the required information is given directly, we can use the formula and you can calculate. If the required information is not given directly, then you have to calculate the required values. You have to extract the required values from the question. This is the basic information you have to keep in mind before solving the practical questions in the capital budgeting techniques or tools methods. Let us start with the first one, traditional methods, non-discounted cash flow methods. Under non-discounted cash flow methods, the first one is payback period method. Payback period method. Payback period means in how many years you are getting that cost of investment back in the form of returns, cash flows. In other words, in how many years the cost of investment will be getting back in the form of cash flows. So what we will do is, after calculating the payback period, you will compare the payback period of the project with the standard payback period of the company. If the calculated payback period is less than the standard payback period, the project will be accepted. Otherwise, it will be rejected. So in calculating payback period, there are two types of methods are there, two types of models are there. What is the first one? Cash flows are uniform, and the other one is when the cash flows are non-uniform. Cash flows are uniform means the cash inflows, annual cash flows every year remain same. Uniform means every year equal, same. So when the cash flows are uniform, the formula used to measure the calculate the payback period is initial investment divided by annual cash inflow. Initial investment means cost of the project only, cost of the cash outflow only, by annual cash flow. So there is an example here. Let us see how to solve this example. So what is the even question? If a project requires 50,000 rupees as initial investment and will generate cash flow of 10,000 rupees, calculate the payback period. So cost of the project is given, initial investment is given 50,000. What about the cash flow? Every year it generating 10,000 rupees. So calculate payback period. Here cash flow every year same only, that is uniform. So what is the formula you have to calculate? Payback period is equal to cost of the investment, initial investment divided by annual cash flow. What is the initial investment? 50,000 divided by annual cash inflow. How much? Every year remains same, uniform, that equal to 5 years. So the payback period for this project is 5 years. That means the cost of the project, the cost of the investment will be returned back, will be received back in the form of profits, in the form of cash flows within 5 years. Okay, that is the meaning of payback period. If you want to make a decision, accept or reject means this calculated payback period will be compared with the standard payback period. But here in this question, standard payback period is not given, so that's why there is no need to write any comment or any decision. But normally this calculated payback period will be compared with the standard payback period of the company. If the calculated payback period is less than the standard payback period, accept the project. If the calculated payback period is more than the standard payback period, reject the project. That is how we will take the decision. But in this question, there is no standard payback period, just only calculate the payback period. Since the cash flows are uniform every year same 10,000, we use the simple formula. Initial investment 50,000 divided by annual cash flow 10,000, that equal to 5 years. This is one model. And another example is here is example 2. A project cost 500,000 and yield annually a profit of 80,000 rupees after depreciation at the rate of 12% per annum, but before tax of 50%. Calculate the payback period. So if you want to calculate the payback period, first what we need, cost of the project. Yes, cost of the project is given 500,000. Good. Then what about the cash flow? The cash flow is given direct cash flow of tax or something other. If you see here, annually a profit of 80,000 after depreciation. That means depreciation is already minus, but before tax, tax is not deducted. That means it is not cash flows, indirectly given. So from this value, we have to calculate the cash flows. Cash flows are not directly available in this question. You have to you have to get the value of cash flows. How? Let us start. What is given? Cash. What is given in this question? Profit after depreciation, but before tax is equal to 80,000. So after depreciation is already minus, but before tax is not minus. So from this, you have to less tax at the rate of 50%. That is how you will get tax value. 80,000 multiply with 50 over 100. That is tax is equal to 40,000. This you have to minus. Since you are minusing less, I am keeping it in the brackets. So if you minus this, then what you will get value, what answer you will get? That is profit after tax. How much it is? Profit after tax is equal to 40,000. This is profit after tax. Then again, we want cash flows. Cash flows means you have to add back depreciation. You have to add back. What is the depreciation value? Depreciation is 12% on the project cost. What is the project cost? So 500,000 divided by 12 over 100. That is 60,000 that you have to add. So in order to use the formula, we need cash flows. But cash flows are not available in this question directly. You have to extract. What is given in the question? Profit after depreciation but before tax. So from that, first you have to minus tax 50% on 80,000, that is 40,000. Then the profit after tax is 40,000. Then you have to add the depreciation back. Depreciation is 12% on 500,000, 60,000. So now that is what you will get is cash flows. Cash flows, that is nothing but cash flows after. We can call as a cash flow, or we can call as a cash inflow, or we can call as a cash flows after taxes. Different names you can use. You can call as a cash flow, cash inflow, cash outflow, cash flow, sorry, after taxes. And now the formula. Already cost of the project is available, no need to calculate anything. So payback period equal to, what is the formula? Initial investment, that is cost of the project. What is the cost of the project? 500,000 divided by, what is the annual cash flow after tax? That is cash flow per annum, 100,000. That is equal, equal, to 5 years. 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 5 The payback period for this project is 5 years. That means the investment you are investing, you will receive back, get back in the form of cash flows within 5 years. This is called calculated payback period. For decision making purpose, as I told before, it will be compared with the standard payback period. If it is available, if not available, you cannot compare. If it is available, you will compare. If the calculated payback period is less than the standard payback period, accept the project. If the calculated payback period is more than the standard payback period, reject the project. That is the decision making criteria. And in this model, the cash flows are not given directly. We calculated, we extracted the required values. This is one model. But here cash flows are uniform. Every year same only. That's why. And next, coming to the other models, model 2 here in payback period, when cash flows are non-uniform. Cash flows are non-uniform means every year the cash flow after tax is changing, differ from year to year. That is called non-uniform. In such a case, you have to use the formula, interpolation formula you have to use for the calculation of payback period. What is that formula? Base year plus balance to be recovered divided by cash and inflow of next year. What is this base year? What is this balance to be recovered? Everything we will see while solving a problem practically. Let us solve one problem. So let us see the problem. What is the question? Certain project require an initial cash outflow is cost of the project 25,000 rupees. The cash inflows for 6 years. It is given for 6 years. 5,000, 8,000, 12,000, 7,000, 3,000. Calculate the payback period for the project. First of all, what is the cash outflow? Cost of the project 25,000. Good. What about the cash inflows? They are given directly or indirectly? Yes, cash inflows are available directly. But they are uniform or non-uniform? Non-uniform, not same. For 6 years, it is different from the year to year. When it is 6 years differ from non-uniform, then we have to use interpolation formula. In order to apply interpolation formula, you have to prepare a table having cumulative cash flow. So this is the table we have to prepare as a part of working notes. 6 years. So okay, first year 6 years, 6 column, right? 6 values are there. And then next one you have to 6 years cash flows are given. How much it is? 5,000. And next 8,000. And then 10,000. Fourth year 12,000. And 7,000. And then 3,000. And now we have to calculate a cumulative cash flow column. Then only you can apply the formula. What is cumulative cash flow column? First year as usual same 5,000. And then second year cumulative means first and second year total. Total of the first and second year. Third year cumulative means total of the first, second and third together. Adding of the all 3 years. Fourth year cumulative means adding of all the cash flows of 4 years. Add cash flows of all 4 years. 5 plus 8 plus 10 plus 12. That is 35,000. Fifth year cumulative means adding of all 5 years. Up to 5 years cash flow you have to add. 35 plus a total 42,000. Sixth year cash flow means adding of all the cash flows up to 6th year all together 45,000. So first year means same first year, second year means 1 plus 2, first year plus second year. Third year, first year, second year, third year, you have to add all 3. Fourth year, total of 4 years cash flow. Fifth year, total of 5 years cash flow. Sixth year means total of 6 years cash flows. This is the total. And now let us see what is the cost of the investment. 25,000. Where is this 25,000 is covering? This 25,000 is in between 23 and 35. Between 23 and 35. That means the cost of the project 25,000 you are recovering between year 3 and 4. Between year 3 and 4. Because it is not 23,000 only covered up to 3 years. But coming to the fourth year, it is more than that one. So it is 3 full years and part of the fourth year. Part of the fourth year. So that's why it is between the 3 and 4. 3 full years plus part of the fourth year. That's why this 3 is called as base year. It is called as base year. Up to 3 years, how much is recovered? 23,000. What is the cost of the project? 25. So still how much is the balance to be recovered? 25 minus 23. That is 2000 still balance. This 2000 is recovering in fourth year, part of the fourth year. But exactly how much? We don't know. We have to calculate that one. So we will apply the formula, interpolation formula we will apply. What is the interpolation formula? Payback period is equal to base year. Base year means 3 plus base year 3 plus the balance to be recovered. That means up to 3 years you recover 23,000. The cost of the project is 25,000. You recovered only 23. Still balance is there. How much is the balance to be recovered? 2,000. How you got 2,000? 25,000 minus 23,000. This 25 is the cost of the project. This 23,000 is the third year base year cumulative cash flow. Divided by next year. Next year means fourth year cash flow. That is 12,000. This is the formula. I given here formula. This is the formula I gave here and it is interpreted here. What is the formula? Base year plus balance to be recovered divided by cash inflow of next year. So it is lies between the year 3 and 4. 3 full years and part of fourth year. So third year is known as base year. So 3 plus balance amount to be recovered. How we will know balance? The cost of the project 25,000. Here how much you recovered? Only 23. So balance 2,000. So 25 minus 23, 2,000 divided by that one. That is, again you can solve it, equal to 3 plus 2,000 divided by 12,000. That equal to 3 plus. So 2000 divided by this one I will keep in the brackets so that you will not confuse. So 2000 divided by 12,000, that equal to 0.16. 0.166 is there. That equal to 3.16 years. 16 years. So the payback period of this project is 3.16 year. That means you are getting this cost of the project cash outflow 25,000 rupees back in 3.16 years in the form of cash flow, cash inflow, cash flow after taxes. If they ask you accept or reject decision means you have to compare with the standard payback period. But here standard payback period is not available, so they need to compare and no decision here. Simply payback period is 3.16 years. So here cash flows are non-uniform, not equal. That's why we prepared a table having the cumulative cash flow column. Then we find out where exactly our cost of the project is covering. It is between the 3 and 4. So 3 years is called as base year. Up to 3 years it is covered only 23,000. So balance 2,000 is the balance divided by cash flow of the next year. Cash flow of the next year means fourth year cash flow 12,000. The value is 3.16 years. In the same way, another model, I am explaining another model. What is this one? A firm is contemplating the following projects. Which one is better according to you? From the above given cash flows, which one is better according to you based on payback period method? So you have to choose which is the best project based on the payback period. But here two projects are there. So you have to calculate payback period of the both the projects. You can compare, and the project which is giving the minimum least payback period, that should be accepted compared to the other. And what is the information required? Cost of the project. Yes, cost of the project is given. How much? 100,000. How you will know? It is minus is given. Minus means cash outflow. Outflow means cost of the project. That is current year, 0 year. Year 0 means present year. The current year, present year is known as 0 year. And you are investing in 0 year. Cash outflow, that is 100,000. What about the cash inflows? As it is given for 5 years, but they are differ from year to year. That means non-uniform. So the given cash flows are given, but they are non-uniform. When the cash flows are non-uniform, you have to apply interpolation formula. If you want to apply interpolation formula, first you have to prepare a table having the cumulative cash flow values. So let us start. First, we will calculate for the project A. So project A table, cash flow and cumulative cash flow column. How much is the cash flows? 25,000, 24,000, 23,000, 20,000, 15,000. Now cumulative cash flow. Cumulative, just now I told you cumulative. First year is same as it is. Second year cumulative means first and second cash flow together. 25 plus 24, 49,000. Third year cumulative means cash flow of the all 3 years together. Cash flow of year 1 plus year 2 plus year 3. That is 72,000. Cumulative cash flow of fourth year means cash flow of the year 1 plus year 2 plus year 3 plus year 4. That is 92,000. Cumulative cash flow of the fifth year means that is total of the cash flow of the 5 years total. That is 25 plus 24 plus 23 plus 20 plus 15. That is 107,000. So cumulative column is ready. Now let us see. What is the cost of the project? 100,000. Where you are getting this 100,000 exactly? Up to 4 years, 92,000. It is less than the cost of 100,000. And in fifth year, it is 107,000. That is more than the 100,000. That means your cost of the project 100,000 is recovering in between these two. In between 92,000 and 100,000. That means in between year 4 and 5. Between year 4 and 5, it is recovered. That means 4 full years, part of the fifth year. How much is part? We will see by applying the formula. I hope you understand. Our cost of the project 100,000 lies in between these two. It is not in fourth, it is not in fifth, between the 4 and 5. So that's why the year between 4 and 5. Fourth year is called as base year. Fourth year called as base year. So 4 full years and then part of the fifth year. Part of the fifth year. How much amount part means? See, up to 4 years 92,000 is covered. Still how much is the balance to be covered? Total cost 100,000. You covered 92,000. Balance how much is there? 100,000 minus 92,000. 8,000 is the balance is remaining to be recovered. That is a simple common sense you have to apply. So let us use the formula. Project project A. Project A payback period is equal to base year. Base year is 4 years. Base year plus amount to be recovered. Amount to be recovered. How much is to be recovered? Up to 4 years, 2,000 is recovered. Still, how much is the balance? 8,000. How you will know 8,000? Cost of the project 100,000 minus the cumulative cash flow recovered up to 4 years, that is 92,000, divided by the next year, that is 5th year cash flow, that is 15,000. Again, one more step. 4 plus 100 minus 92, that is 8,000 divided by 15,000, that equal to 4 plus how much it is? 8,000 divided by 15,000, 0.53. 0.53 is the amount we are getting here, 0.53, that equal to 4.53 years. This is the value payback period for the project A. Project A. I calculated cumulative column. In cumulative column, our 100,000 lies in between the 92 and 107, that is between year 4 and year 5. The 4th year is called as base year, and the balance to be recovered is 8,000, and the next year 5th year cash flow 15,000. Apply in this formula. In this formula, substitute the values, and I got 4.53 years. Now project B. Project B is payback period. Payback period is equal to, first we have to calculate the cumulative column. Cumulative column is not ready. Then see here. What about the cash flow of project B? We didn't fill the columns. First of all, fill these values. 35,000, 20,000, 24,000, 23,000, 18,000. Let us calculate the cumulative column. Just now I told you how to calculate cumulative column. First year same 35,000. For second year, for year 1 cash flow plus year 2 cash flow. For third year, year 1, year 2 plus year 3 cash flows. 35, 55 plus 24, 79. For year 4, cumulative means add the cash flow of year 1, year 2, year 3 and year 4. 79, 99, 10, 2000. Last year 5 means adding the cash flow of all 5 years. 120,000. Let us see. Our cost of investment 100,000. Project B also 100,000 cost of the project. Where you are recovering this cost of the project? Year 3 79,000, less than the 100,000. Year 4 is 102,000. That means more than the 100,000. Means it is between year 3 and year 4. Our cost of investment 100,000 is recovered in between the year 3 and year 4. 3 full years and part of the 4th year. What is that part of the 4th year? We will see in the formula. So third year is called as base year. Let us start. Equal to project B payback period equal to base year 3 plus balance amount to be recovered. Up to 3 years, how much is required? 79,000 only recovered. What is the cost of the project? 100,000. Out of 100, you are recovering only 79,000. Still, how much is the balance? 21,000 is the balance. How you will get 21,000? I am writing here. Cost of the project 100,000 minus the cumulative cash flow of the third year, that is 79,000, divided by next year cash flow. Next year means 4th year. 4th year cash flow is 23,000. Again I am writing here 3 plus 100 minus 79 means 21,000. 21,000 divided by 23,000, that equal to 3 plus what is the value? 21,000 divided by 23,000, 0.91, that equal to 3.91 years. The payback period for project B is 3.91 years. That means the cost of the project B 100,000 is recovering back in the form of cash flows in 3.91 years. Now you have two projects, you have to choose which is acceptable, which is the best one. So decision, as I told you before, the decision will be the project which is giving the least payback will be accepted. Project A 4.53, project B 3. Which is the least one? 3.91. Project B is the least one. So that's why project B should be accepted. Decision. Let me write the decision here. Project B should be accepted as its payback period is minimum compared to project A. So since the project B having the least payback, it should be accepted. That is the decision. In case of single project, we will compare with the standard payback period and we will take the decision of accept or reject. In case of more than one project, you will compare them and whichever is the least payback period, that should be accepted, like that. So this is about the payback period method. Two models I covered: when cash flows are uniform, when cash flows are non-uniform. When cash flows are uniform, direct formula, initial investment divided by annual cash flow. When cash flows are non-uniform, not equal, you have to apply the interpolation formula. For that, you have to prepare a column table with cumulative cash flows, and then you have to identify the base year and how much is recovering in the base year, balance to be recovered, and the next year cash inflow. That formula you will substitute the values and you will find out the payback period. And here the cash flows are given directly. Cash flows are given direct values. If cash flows are not given directly, then again you have to extract the values of cash flows also. But here they are given directly, so we took the values of cash flow direct from the question. This is about the simple in payback period method, simple problems explanation. And the next one is another, here is given one more problem. I am going to solve it. Okay, here what happened is, this is three projects are there. Calculate the payback period of the following project each requiring a cash outlay of 100,000. Suggest which project is acceptable if the standard payback period is 5 years. So here the cost of the project is all three projects same cost required 100,000, and which project is acceptable based on the you have to take decision, but standard payback period is also given here 5 years. Okay. First of all, cost of the project, cash outlay 100,000 each project. Okay. Coming to the cash inflow, cash inflows of project A, B, C is given. If you observe project A cash flows, every year 30,000, 30,000, 30,000. That means cash flows are uniform. Cash flows are uniform. Every year same. When they are uniform, you can apply the simple formula. Coming to the project B and project C, what happened? They are non-uniform. So you will apply the interpolation formula, you will apply. Let me see. Project A equal to project A payback period is equal to simple. What is the formula? Initial investment, cost of the project 100,000 divided by annual cash flow. The cash inflows are given directly. Cash flow, cash inflow, cash flow after taxes, all are same. Project A cash flow every year 30,000. So annual cash inflow 30,000. That equal to 100 divided by 30,000 is 3.33 years. So payback period of project A is simple formula because cash flows are uniform. But coming to the project B, what happened? They are non-uniform. You have to apply the interpolation formula. If you want to apply the interpolation formula, then you have to prepare a table having the cumulative cash flow column. Project C is also non-uniform. So you have to calculate the cumulative cash flow column for project C also. So I made here table. How many years it is? 1, 2, 3, 4 and 5. It is same only. Year is same. Okay. And what about the cash flow? 30,000. And I'm solving for project A 40,000, 20,000, 10,000, 5,000. Tell me next cumulative column. Already we solved many questions. Every 30,000, 30 plus 40, 70,000, 70 plus 20. You know cumulative means adding of all the cash flows. Secondary cumulative means these two. Adding of the first and second. 90,000 means these three. And next one is cash flow of all 4 years together. And next one is cash flow of all 5 years together is called cumulative column. What is your cash outflow cost of the project? 100,000. Here where you are getting the cost of the project? This one. You are recovering 100,000 exactly at the end of the 4th year. At the end of the 4th year, you are receiving 100,000 back. So there is no need of interpolation formula. If it is in between the 4 and 5 means, then you have to use the formula base year plus and all these things. The cost of the project 100,000 is recovering back exactly at the end of the 4th year. So no need of any formula. Directly you can write down payback period. What is that one? Project B payback period is equal to directly you can write down here. The answer is already got it directly 4 years. How you got it? Cost of the project. Where is your cost of the project recovering in cumulative column? Here. Is it in between this one? No. Exactly. At the end of the 4th year, exactly 100,000. So 4 full years. Finish. Project B payback period is 4 years. No need of any interpolation formula here. Next, come to the project C. What about project C? We have here cash flows, how much it is, only for 4 years they are given. Okay, 10,000 and 20,000 and 30,000 and 40,000. Fourth year it is not there, blank. So calculate the cumulative column. First year same 10,000, second year 1 plus year 2, then next year 1, 2, 3 all plus, and next one is year 1, 2, 3, 4 all plus. So, and now see what is the cost of the project. See also 100,000 only. Where you are getting this 100,000 back in the cumulative column? Is it between? No, exactly 100,000 here. Where? End of the fourth year. So here same, no need of interpolation formula. Project C payback period is equal to, here also the project B payback period is given directly. Calculated the cumulative column because cash flows are non-uniform. But when you see the cumulative column, the cost of the project is exactly covered here by the end of the fourth year. So full amount is required by the fourth year ending. So there is no need of any mixing, no base year, no interpolation formula. The answer is 4 years. So directly by seeing this table, you identified without using the formula, nothing. Which year your cost of the investment is recovered? Here, fourth year ending. Here also, fourth year. That's why. And now project A payback period 3.33 years. Project B is 4 years. Project C is 4 years. Here he asked in the question, which projects are acceptable if the standard payback period is 5 years? All three are less than the standard payback period. All three are less than the standard payback period, so all three are acceptable. All decision. Since all the three projects payback period is less than the standard payback period, all three should be accepted. But still, if you want to choose which is the best one, means project A, because project B and C 4 years it is project A only 3.33 years you are recovering your amount back. So all three projects are acceptable because their payback period is below the standard payback period. All three are acceptable. When compared to the standard payback period, all three are acceptable. Still, if you want to see out of three, project A is more acceptable. More acceptable means more suitable because its payback period is minimum compared to project B and C. So actually, if there is no standard payback period is given, we will compare all three together. Out of three, which is the least one? A is the least one. So out of three, A is the acceptable project. But in the question, they ask you to compare with the standard payback period. If you compare with the standard payback period is 5 years. So project A, project B, project C, all three are below the standard payback only. That's why first you can write down all three are acceptable, because all three payback period is below the standard payback period. But still, out of three, which is the more acceptable, most acceptable is project A, because it is minimum. How much? Only 3.33, remaining to how much? 4. So comparatively A is more suitable, but all three are acceptable. So this is the payback period calculation. So in this video I am able to cover only payback period method. In the next video I will cover the accounting rate of return or average rate of return method, one of the traditional non-discounted cash flow methods I will cover in the next video. So at a glance, in simple, payback period, in how many years you are getting your cost of investment back in the form of cash flows. So here we solve when the cash flows are uniform and non-uniform. When the cash flows are uniform, simple formula: initial investment divided by annual cash flow. When the cash flows are non-uniform, we have to prepare a table with the cumulative cash flow column, and in the cumulative column you have to identify exactly how many years it is taking to recover our cost of the project. It may be exactly number of years, or it may be in between the years. So you have to apply the interpolation formula, and you have to find out the base year, and up to base year how much is the recovered amount. Still balance is how much should be recovered, balance, and next year cash flow we use the formula, and you can apply, you will find out the payback period. Okay. And here one more thing is, if the cash flows should be given directly, if the cash flows are not given directly, means then you have to extract, you have to find out. Maybe they give before depreciation and tax, or before depreciation after tax, like that you have to check carefully. So this is about the payback period with a single project, 2 projects, 3 projects, cash flows uniform, non-uniform. I hope you understand, it is useful for you. So if it is useful for you, it is little lengthy, I was explained more clearly. If it is useful for you, please subscribe to my channel and share, my dear. Thank you. Have a good day.